how to qualify for more home. You know how many people I run into who qualify and they're not happy with what they qualify for? The reason why they're not happy because their debt to income ratio is too high. So the name of the game is, how do you manage your budget to qualify for more home? Let's recap here. So how do you manage your budget, right? Like we went over already on a conventional loan, right? So if you make $10,000 a month, right? This is just for numbers. To make it easy, I did 10,000, right? Times it by 45%, your max mortgage payment can be $4,500, right? Your max debt, $5,000. That leaves you $500 a month in wiggle room. If you go with a government loan, $4,500, and your back end is $5,500. That leaves you $1,000 in wiggle room. Jumbo loan, 43 over 43, leaves you no wiggle room. That's if you go with a max mortgage payment. Of course, you know, even though you qualify for the max mortgage payment, I do not recommend, hear me out here, I do not recommend you go with the max mortgage payment. Unless for some reason someone is going to help you with the mortgage payment and they can't go on the loan, or there's some sort of income that they can't document, but even though you can afford the payment, it just doesn't look that way on paper. Okay, so this is the perfect scenario. If you maxed out your mortgage payment, leaves you a little wiggle room. But anyone who makes $10,000 a month, realistically, will probably have more than $500 a month in debt or $1,000, right? Here's an example of a non-perfect scenario, okay? So if you made $10,000 a month, and let's say you had $1,000 in debt, you would qualify for a $4,000 mortgage payment. That's why I tell you guys, take your monthly gross income and times it by 50%. So we did it right here on this convention. We took 10,000, we times it by 50%, which is $5,000. That means our total monthly debt can exceed 5,000. As you can tell here, 1,000 plus 4,000 is 5,000. So if you have $1,000 a month in debt, you can afford a $4,000 mortgage payment. So you will qualify for $500 less home. So let's say you have $1,500 a month in debt. That would allow you $3,500 mortgage payment. If you have $2,000 a month in debt, that's a $3,000 mortgage payment. If you have $2,500, a $2,500 mortgage payment on a conventional loan. Look over here in government. If you make $10,000, times it by 55%. Remember, their total back end is 55. But if you have no debt, remember, you'll have to times it by 45. So you know you can't exceed the max mortgage payment. So let's say you have $1,500 in debt, $4,000. $2,000 a month in debt, $3,500. As you can see, government loans are a little more flexible when it comes to debt. But that right there gives you an example of how to manage your debt. Manage your debt to manage your mortgage payment. The more debt you have, the less buying power you have. Like I said, when most people qualify to buy a home, they're not really satisfied for what they qualify for. The reason why is because they won't enjoy the home. They're like, whoa, I know I can afford such and such, but the payment doesn't say so. But now you know how to budget it. The secret to buying the home that you want, the secret of being a good loan officer and a good real estate agent is the Seesaw Game. Right? I've been doing loans since 2003. I've had over 100 loan officers work under me. I tell them the secret to being a good loan officer and the secret of life and for a borrower to be happy is a Seesaw Game. You know your debt to income ratio. Once you know what program you're going with, what the max debt to income ratio is, it's the Seesaw paying down debt so you can qualify for more home. The more debt you have, the less home you can get, right? It's a Seesaw Game. As you balance out that seesaw, you will have more buying power. So there's 4 ways to bring down your debt to income ratio. There's 4 ways to balance out that seesaw. So when you're qualifying to buy a home, that's why I tell people, don't pay off debt yet. Don't do anything yet. Be prepared. Talk to a lender. Identify with the lender who's going to be on the loan to help you with the mortgage payment. Identify your debts. Identify your program so you can calculate the right debt to income ratio, and then use these 4 strategies to increase your buying power. Here's 4 ways to bring down your debt to income ratio. Number 1, drop your purchase price, which no one wants to do, but it's the easiest way to bring down your debt to income ratio or balance out your mortgage budget, right? Drop the purchase price. Number 2, bring in a bigger down payment. Sometimes you might have to tap into your 401k or into your retirement or break a CD to bring in a bigger down payment so you qualify for more home. Number 3, pay off debt. The more debt you pay off, the more home you qualify for, which we went over in our example. And number 4, which I don't love, adding a cosigner. The only time I would add a cosigner, of course, if they're going to help you with the mortgage payment, that's the best. But if they're not going to help you with the mortgage payment, make sure there's someone who's going to help you with the mortgage payment. They just couldn't go on the loan. Because they couldn't go on the loan, they can't help you with the payment. If they can't go on the loan, they can't help you qualify. But if they go on the loan and they can help you, make sure you have someone to help you. Let's get into bringing down the purchase price. So before you decide how much to drop the purchase price, you got to figure out what program you're going with. Make sure you follow the debt to income ratio. Are you going with the conventional government loan or a jumbo loan? Now that you know, once the lender calculates your DTI, they'll tell you how high your debt to income ratio is or how high your mortgage budget is that you have to bring down to qualify. Now you know, okay, start bringing down the purchase price, right? Find out what program you're going with. Make sure the income has been validated. I see so many people fall out of escrow. They've been approved and they're not approved because income has not been validated. Make sure all your income has been cleared by the underwriter or the loan officer or the processor so you know what you're working with, right? You got to know what you have so you know what you're working with. Once you identify what you're working with and they've ran your credit, they'll know what your debt to income ratio is, then slowly bring down the purchase price until it fits the right guideline for the right program. So you keep bringing down the purchase price, which no one loves to do, but it's the easiest way. Bring down the purchase price. The second way we talked about bringing in a bigger down payment. Remember, the number one thing you can do, validate your income. You always want to validate your income first. Then check what program with their DTI. When you start increasing the down payment, right? It's a seesaw game. You increase the down payment, see what the DTI dropped down to, right? Keep increasing the down payment. Once you get that number, you want to look at that number. Is this number realistic? Do you already have it? Or how long will it take for you to save that down payment? Sometimes if it takes a year, 2 years, 3 years to save a down payment, the home might be out of the market already. Let's say you need to save $24,000, but you can save $1,000 a month. So in 2 years, you'll be able to save the money. But what will the home price of the home be in 2 years? Are you saving fast enough to beat appreciation and inflation? If you're not, you might need to change your strategy. You might not be able to do the second way, right? You might not be able to save a bigger down payment. Another thing you can do is you might want to talk to a lender. If you're doing less than 20% down, you might want to buy out the PMI. You might not be able to save 20% down, so you don't have PMI, but maybe you go 5% down and you use 2% to buy out the PMI, or you go 10% down and you pay 1% to buy out the PMI instead of going 20% down to get rid of PMI. There's other strategies of bringing down your DTI. Instead of bringing a bigger down payment, maybe use some of your down payment, buy out the PMI, see if it'll drop your payment. Okay, so that right there is a second step to lowering your DTI, which helps you with your mortgage budget. Now, the third way to help you with your mortgage budget is paying off debt. That I feel is the most efficient way to allow you to qualify for more home. First, if you have debt, how much debt do you have, right? When you talk to a lender and they run your credit, you have the credit report, you want to look at all your debts. Sometimes you might have a debt that's a car payment or a car that has a couple $1,000 on it, but it's a $300-400 payment. That can affect your debt to income ratio. So when I tell people paying off debt, look at your debts first. Is it easier? So I did this number with $50,000, right? So typically most people will qualify $50,000 less. The payment that they qualify for is typically $50,000 less to the home they actually are in love with. So I did $50,000. Some of you guys are $100,000, right? So is it easier to drop the purchase price $50,000? Some people don't want to do that. Is it easier to bring in $50,000? That is even a harder thing to do, right? So right now, if rates are at 3%, we did this on an FHA loan, right? Of course, rates can change. This is just numbers here. I crunched the numbers on a $50,000 home. I know there's homes out there not for $50,000, but I did worst case scenario on a $50,000 home with PMI and FHA loan. If rates are at 3%, the monthly payment is $340. That means for every $340 a month, that's $50,000 more home. You might be able to look at your credit cards like, hey, I might be able to eliminate a $10,000 credit card instead of bringing in $50,000 or coming off the purchase price $50,000. So if the rates are at 4%, it's $370. If rates are at 5%, $400. If rates are at 6%, $430, which means you would have to pay off that much in monthly debt to qualify for $50,000 more home. So that is the third way to help you with your mortgage budget. Number one, we talked about bringing down the purchase price. Number two, we talked about bringing in a bigger down payment, which could be a lot harder because depending on how long you need to save or unless you already have the money. Number three, paying off debt, which I love the most, probably is the most efficient way to do it. And the last but not least, which is not my favorite, but I still got to talk about it, adding a cosigner, right? Adding a cosigner. What did Spider-Man say in the movie Spider-Man? With much power comes much responsibility. So if you add a cosigner, that's a lot of responsibility because if you miss a payment, it affects their credit. If you add a cosigner or co-borrower, right, and they're not going to be helping you with the mortgage payment, even though you're using their income to qualify, if they're not helping with the payment, what's the use of that? Unless there's someone who's going to be living there helping you with the payment and they can't go on the loan. Unless you're self-employed, you got some funky income and the lender cannot use it for some reason, then I think a cosigner is okay. But if you don't have help and you can't qualify straight up and you add a cosigner just to qualify, I think it will hurt your chances. Carefully choose the right cosigner. Everyone has an Uncle Rico, right? He has cars, has a nice home, has a boat, but no one realized when you lift up Uncle Rico's hood, he might not be the best person to help you qualify. He might actually hurt your qualification because he has so much debt. Because they have a lot of credit doesn't mean they're the right cosigner. Here are signs of a great cosigner. So before you get your Uncle Rico involved or start running everyone's credit, here's signs of a good cosigner. Sign number one, that cosigner better have better credit than you. If their credit is not as good as yours, unless you need them that badly, their lower score can hurt your credit profile, which means you can qualify for less home because you have a higher interest rate or it's a payment you're not in love with. So the perfect cosigner would typically have the same credit as you or better. Number two, a solid job. Make sure they have consistency with work, even though they have really good credit. If they're not consistent at their work, you can't use the income to help you qualify. Make sure they've been at that job or the same line of work for 2 to 5 years. If they're self-employed, make sure they actually showed income on their tax returns, which a lot of self-employed people who always want to help their uncle or their cousin or whoever qualify writes off everything. The third sign, minimal debt. Like I said, sometimes Uncle Rico might not be your best choice. The reason why? He got too much debt. You want to make sure he has minimal to no debt because every debt he has is counted against your debt to income ratio, right? Your complete back end debt, as we talked about earlier. So make sure there's minimal debt. If there's not minimal debt, there better be insane amount of income. And last but not least, the perfect cosigner is not paying rent or doesn't have a huge mortgage. Remember, if they have rent or a mortgage, it counts against your debt to income ratio, okay? So when you're out there looking for cosigners because you don't qualify and someone else is gonna help you with the payment, you just need a cosigner. If someone has rent, that rent is counting against your debt to income ratio. If they live rent-free, then that's okay, right? That doesn't hurt you. But if they have a mortgage, that is also counting against your debt to income ratio. Imagine if they have investment properties as well. That can really hurt your chances of getting a home. I see so many people scramble for cosigners because the lender didn't validate the income. So the debt to income ratio was off. And now they don't want to drop the purchase price. They can't bring in a bigger down payment. They can't pay off debt. And they got this boo-boo cosigner that pretty much is hurting them compared to helping them. And I see it happen a lot. So be very careful with the cosigner. So those are the 4 signs of a great cosigner. And remember, when you add a cosigner, remember the math, right? I typically do whatever the debt is, times it by 2, right? I'll do the 50% debt to income ratio. So for $50,000 more home, if rates are at 3%, right? Like we said earlier, when rates are at 3% on a $50,000 home, the monthly mortgage payment is $340. So it's 50%. That means you have to times it by 2. Someone has to make double the amount of money to qualify for that payment. For example, if you have $1,000 a month in debt, you can't make $1,000 because you can't live. If someone has $1,000 a month in debt, they would need to make $2,000 a month in income to qualify to pay that debt. So for $50,000 more home, if rates are at 3%, your cosigner needs to make at least $680 a month without debt. When rates are at 4%, they need to make $740 a month. Of course, if they have debt, they need to make more money. If they're at 5%, they got to make $800 a month. At 6%, they got to make $860 a month to qualify for $50,000 more home. So hopefully that helps you right there decide if you're going to add a cosigner and what type of cosigner to look for. The last thing you want to do is scramble in escrow looking for that cosigner and all of a sudden you don't qualify. And that right there, my friends, is the secret to budgeting your mortgage payment. So turn off the notifications on Zillow. Don't tell any more friends or family what your plan is to become a homeowner. Figure out your budget first. There's 2 phases. Phase number 1, identifying your budget. Who's going to be on the loan? What debts to include in the loan, what program you're going with so you can calculate your debt to income ratio. And the second phase of your mortgage budget is managing your budget. How much income do you have? How much debt do you have? Do you need to bring down the purchase price, pay down debt, right? Bring in a bigger down payment or add a cosigner. Once you decide all that, then you can move to the next step of credit. That's why it's important. People ask me all the time, like I said, what's the first step to home ownership? And the first step is mortgage budget, right? That's the secret to figuring out your mortgage budget. Hopefully, guys, this video brought you a lot of value. Do me a huge favor. Save this video, share this video, and like this video. And if you're not following us on Facebook or YouTube, please hit the subscribe or notification button.